Hey guys, this is Scott Horn with the Owner Finance Network. And in this video, we're going to take a moment and just talk about high interest rate loans that you might want to consider taking subject to and some thought processes along the way you should be thinking about. So again, if you like the video, please like it. Give us any comments below. We'll do our best to get back to you on that. And jump over, guys, and come join our YouTube channel as well. We'd love to have y'all. High interest rate loans and subject to deals. And guys, I'll give you all a little bit of history here in just a minute. You go back to the 70s and the 80s where interest rates were crazy high. 16, 18, heck, there were some that were in the 20% range back for home mortgages. Who in the world wants to take over an 18% interest rate on a home mortgage? You don't. Different times, different things. So these loans were filtering through in the 90s, and at this time of the investment career, you could get bank loans between 7 and 8%. So what are you going to do? Go to the bank and get a loan for 7 to 8, or take over a 16, 18% interest rate loan? That doesn't take rocket science to figure that one out, what you should be doing. Now, fast forward to 2008, 2009, the real estate crash. What was going on? Interest rates that dropped down to almost nothing, and everybody in the country refinanced their loans, or it seemed like they did. And now we have this plethora of low interest rate loans between 2.5% to 5% out there. Those are awesome loans to take over because we may never see those rates that low again in our careers. But you are running across loans out there right now that have higher interest rates. Maybe it's a bank rate loan, some other type of a mortgage loan that has an 8% interest rate on it, let's say. Maybe it's a 10% rate. We see these DSCR loans that are out there, which is a mortgage loan to investors, and they may be between 7 and 9%. So again, I call those a little bit higher interest rate loans, although think about this. Today, in the banking world, if you go borrow money from a bank, you're going to be looking between 7.5% and 8.5% interest rates with a 1-point fee on that loan, typically on a 15-year note. Your DSCR loan that you might want to take over may be the exact same interest rate, except it's going to be on a 30-year term. Okay, well, you can't get a better bank rate loan than that DSCR loan, so is it worth taking over from a subject to perspective? Sure. So you look at things and you analyze them through that type of a lens on what's available, what are the other options, and maybe if they're the same thing as that is, same thing only different as we say, do the deal. But when you're looking at these, you still need to make sure you're running your numbers. I always tell investors as they're doing this, it's not about just because someone's willing to sell their house subject to, and maybe it does have a higher interest rate loan associated with it, is do the numbers work? You've got to know what your back end strategy is. And guys, different states act very differently. For instance, here in the Texas marketplace, using DSCR loans, using bank loans, because taxes are high, even though they have come down here just recently for us on our property taxes, rent rates have not at all caught up. And so often, for instance, on a $300,000 house, you might be able to get $2,000, $2,200, $2,300 in rental, and that just flatly doesn't work. It might break you even on a 30-year note, with your mortgage, your taxes, and your insurance on that property. And keep in mind, here in Texas, insurance rates have skyrocketed because all of the damages that we have had here in Texas over the last 3 to 5 years. So you've got to run your numbers and look at what your back end strategy is. Airbnb may work with the right property, the right place. Short-term rentals might be a little bit harder. Mid-terms might be a little bit easier. Run the numbers and do the math and see if taking over that loan works for you if it's a higher interest rate loan. So how do you make those kind of deals work? Well, if that's the situation, most likely you may need to be doing a wraparound loan instead of a rental property to make that work. Now, if you're going to live in the property yourself and take care of it, taking over that loan, if that's the best rate you can get in the marketplace right now or pretty close to it, cheaper and easier, go for it. You can always refinance down the road as rates drop down a little bit. But always analyze the numbers and see if the deal works. Now, you get outside of Texas into a lot of other states, Property taxes are much lower. Rental rates are a little bit higher. Now the numbers start to work a lot better. And sometimes in these smaller towns, the rental rates are a little bit higher because you can buy the property for less money. There's always this symbiotic relationship between the value of the property, your principal, interest, tax, and insurance numbers that you've got to pay on the property, what a buyer's going to pay on rental or on a mortgage on that house if you can sell it to them. And you look at things through all these lenses, not just one way. Jump out of Texas, everything changes. A lot of these places you can buy houses a lot cheaper than you can here in the Texas marketplace, but values just don't rise, they're stagnant. But you can generate some attractive cash flows. Well, sometimes that's just as good as anything else if that's what you want to do. So even though you have some high interest rate loans out there, it's based on, I think, the marketplace you're in. I think it's based on what the rental marketplace is for your particular area that property is located in versus maybe a wraparound mortgage, for instance. Which one works the best? And I'm going to take out of the equation something for yourself personally, because that really doesn't count in this instance. But you have to look at these things, analyze it, and look at it. Sometimes it's best just to walk away. The numbers just don't work. They're just too high. Take the time, do the math, run the numbers, analyze it from different perspectives. If it works, do it. If it doesn't, walk it. Just because it's available doesn't mean it's a deal. So guys, I hope you found the video helpful. Think about these kind of things. Comment below, happy to get back to you on those. Check out our YouTube channel. Hope you get a chance to join, and we'll see you all next time.